and let me, on behalf of the World Bank Group, extend a warm welcome to all the participants. Before I get into the presentation, I thought I should give you all a background about why we are doing this program. IFC's Global Credit Reporting Program is an internationally recognized leader in the credit bureau development. And this Global Credit Reporting Program focuses on 4 areas of intervention. One is to develop an environment that encourages both public and private sector credit information sharing. It also provides direct support to establishing new credit bureaus and registries and enhancing existing credit bureaus and registries. The third area of intervention is developing credit information management tools, and the last is the knowledge dissemination. The overall aim of this ongoing World Bank Group project is expanding the level of credit information available on the MSME sector through improvements in the credit information infrastructure in India. So with that background, let me move to the presentation. We're going to start off by trying to understand the access to finance by the MSME sector as such. Now, before that, let's try and understand what are the various challenges faced by the sector as a whole. So if we look at the MSME sector, there are a number of challenges that they face on a day-to-day basis, which includes limited production capacity. They face a lot of issues as far as the infrastructure is concerned. There could be technology constraints. There could be competition because there are a number of SMEs who manufacture very similar products and cater to the original equipment manufacturers, for instance. There are regulatory concerns which are faced by the MSMEs. More importantly, also are issues relating to the ineffective marketing given the size of operations, as also the lower level of tiers in which they operate compared to the original equipment manufacturers. And of course, access to finance is a big challenge as far as the SMEs are concerned. Now, many of these challenges can actually be sorted out or solved if they have additional funds. And that is what we're going to be talking about today in terms of what are some of the areas that the SMEs can do to mobilize these additional funds. Now, in this section, we're going to quickly discuss what is credit, what do SMEs typically require credit, the typical documentation which is required during a loan application process, the formal financing options available, and of the options that are available, what is it that the SMEs get out of it. And much of our discussion today is going to focus in terms of the credit report and how important it is for the SMEs and the promoters of SMEs to give a lot of attention to the nuances of credit reporting. Then we also will quickly take a look at what is it that typically loan officers look at and what are the key points as far as successful application is concerned. So if you look at credit, there are various types of loans which are borrowed. One could be personal loan for the promoter who could take a housing loan or a loan for the car or any of the other vehicles that they may choose to buy. The second typically would be the business loans, which would typically be in the nature of a working capital loan or a term loan if there's going to be a capital expenditure that the MSMEs have embarked on. And the third version of the credit is through credit cards. And credit cards, again, is a very important form of credit, and that is something that is also resorted to. So when an SME requires credit, what are the typical steps that are undertaken by the SMEs? The first step, obviously, is to decide on what is the type of loan. Is it going to be a working capital loan, or is it going to be a loan which is going to be used to inject capital into the SME? And then you also have to decide on the quantum of the loan, which again would be a function of either the capital expenditure that is planned by the SME in the coming year, the dues to the suppliers. It could be for day-to-day expenditure and running of the SME, or it could be funds which could be required for expansion. And it will also depend on how much is the repayment capacity of the SME. And once you have decided on the type of loan and the amount of loan, you decide on which bank to approach for the funds. So it could be your own bank that you're dealing with traditionally, or you could approach another bank to seek credit. Now, interestingly, if you look at the sources of financing for the MSMEs, we find that of the total funding which is, or financing which is sought and obtained by the MSMEs, you find that almost about 93% of the financing is self-financing, or in other words, it means that there's no financing either from formal sources or informal sources. And that is really a cause of concern, because you find that the formal financing institutions, could be banks or any of the other lending institutions, constitute only 5%, and the informal financing is only about 2%. So one really needs to look at, how do you move from this 93% and increase the share of the banks and other formal lending institutions. So typically the formal financing options that are available are from the commercial banks. There are a number of non-banking finance companies or institutions which do cater specifically to the MSME sector. There are microfinance companies which offer typically smaller tranches of loan to the sector. And then, of course, there are the cooperative banks which are present across various of the states of our country, the housing finance companies and so on. And today we also have the newer small banks which have been specifically set up to cater to the funding or financing requirements of the SMEs. So once you've selected the bank, what are the next steps that the SMEs typically go through? You would have to go through your documentation and provide the documents which are required by the banks, typically the KYC documents or the documentation that is required by the banks. We'll talk a little more about it subsequently. And then we move on to the processing of the loan application by the credit officers in the banks, post which the bank decides whether to reject the loan or to give the loan to the SME. So this typically is a broad process which I'm sure that many of you would have gone through. Now the typical documentation that you would require would be in terms of the registration papers, which would typically tell the bank the constitution of the company. It could be a proprietorship, it could be a partnership, or it could be in the form of a company. And then of course the other documents which would include the identity proof, your proof of residence, the various bank statements, as also the audited financial statements by the chartered accountant, as also the income tax returns, which will be either for 3 years or the past 5 years. So these are typically the documents that you would provide me. Now, in addition to that, the bank will also obtain an important document, which is the credit report. Now, this is something that every bank will seek to analyze whether you're an individual or you're a company. And this essentially means that the credit report will get a snapshot picture of your credit history over the last 3 years, typically, not only about the company, but also about the promoters and the directors and so on. We are going to be talking about it in a little more detail as we get along. So if you look at the typical process which we just talked about, once you complete and submit the application, the loan officer is going to peruse the application, check out the documentation, and figure out whether it meets with the basic requirements of the bank as far as lending to the sector is concerned. And then, based on the internal criteria that a bank might have, will decide on the credit worthiness of the company. And it is at this juncture that the bank will decide whether to lend or not lend to the SME. So if you look at creditworthiness, basically it means whether the underlying borrower is going to repay the loan back on time or whether there's going to be a default on the loan. So that essentially is what the credit officer is trying to measure. So the more creditworthy a borrower is, the more is the probability of the borrower getting a loan. The borrower can get a larger quantum of loan, and logically speaking, higher the credit profile or the credit quality, lower is going to be the interest rate. So essentially, it's going to be a risk-return paradigm as far as the bank's lending officer is concerned. So if you look at the creditworthiness in terms of how we are going to measure it, it is going to be a combination of two things. One is the repayment capacity, and the second is the repayment willingness. So what do we mean by repayment capacity? Repayment capacity is essentially trying to judge whether the company will be able to generate sufficient cash flows to repay the underlying loans, both the interest and the timely manner. And obviously, if you have to do this, we have to analyze a number of factors before the officer can decide on the repayment ability of the borrower. So there would be 2-3 key factors that one would discuss in the repayment capacity analysis. You would start with the industry in which the company operates to understand, what is the industry dynamics and what are the market forces which operate. The basic attempt here is to understand if the business is going to be viable in the next few years during the time of the tenure of the loan. Following this would be the company-specific analysis, which would include analyzing the market strengths, the market position of the company, the operating efficiency of the company, and so on. Now, once the company analysis has been done, one has to look at the financial statements and the financial position, wherein the officer is going to look at the current financial position, the sort of cash flows which are being generated, the probability of a revenue growth and a profit growth in the years to come, and there are a certain set of ratios that they will also be looking at. Now, in any analysis of the SME, the analysis of the promoters and the underlying management assumes a lot of importance, and there are going to be discussions with the key promoters. There will also be the checking of the documents to make sure that everything is fine. And then, of course, there is going to be the credit report. Now, the credit report, which is being perused by the officer, will contain all the loans that you have borrowed in the past and the sort of repayments that you are making on those borrowings, and what is the current status of the loans or the borrowings which are outstanding as far as the company is concerned. And not only that, it will also check out the repayment track record of the company on each of these loans to see if there is going to be a delay as far as the payment is concerned or not. So this is essentially what the bank is going to be analyzing as far as the repayment capacity is concerned. Now we'll talk more about the credit reporting in a while from now, but just to understand what is a repayment willingness. The repayment willingness essentially is a measure of the willingness of the management to actually repay the underlying loan, both the interest and principal. So it is a management willingness issue, and this is basically done through interactions with the promoters to understand the past track record of payments on various borrowings that the company has taken, and also looking at the credit report in terms of trying to understand what has been the past behavior on the various loans that the entity has taken in the past. And once the officer is able to get a clear picture in terms of the past track record, the officer will be able to analyze the willingness of the management to make the payments on the borrowings. So a combination of these two will eventually decide as to whether the loan is going to be sanctioned or not. So if you look at some of the key points for the application, when a bank is looking at a company, it is not only looking at the company as such, it is also looking at the promoter. So it will be, the bank is going to pursue both the documents of the promoter as also the company. The second important point is if there is a guarantor for any of the loans, those documents also have to be provided to the bank. And the third important point is the requirements as far as the application is concerned might vary from bank to bank. So you need to ensure that you have submitted all the documents as far as your company, promoter, and whatever else on the company's operations are concerned. Also, you have to realize that credit cards are also an important form of credit. So you will be providing details on that. And anyway, the bank will get details on your credit card payments from the credit information reports. So with that background in terms of how a bank is going to be analyzing the SME, let's go to our main topic, which is the credit information, the reports, and the credit scores. So here we're essentially looking at the credit information sharing in terms of how it works, what is a credit bureau, is your information safe with the bureaus, who uses the bureaus, do individuals whose data is there, do they use the credit bureau or is it only banks? So we look at that. What are the various credit bureaus in the operating in the country, and what is not a credit bureau? So let's just look at a simple case study to understand the importance of the credit information. We can look at a hypothetical situation where we have two entrepreneurs, Mr. Mishra and Mr. Banerjee, who respectively have their companies, which could be a manufacturing company in the case of Mishra and Company, and it could be a trading company. Both are classified as SMEs and both have applied for a loan. So if you look at Mishra and Company, the loan has been approved because the application form seems to be fine, the documentation is all right, and the credit report is also okay. Whereas Banerjee and Co, while the application form and documentation is fine, the credit report is not okay. So obviously there was something wrong with the credit report, which sort of signaled to the bank that the loan should not be given to Banerjee and Co. So what could have gone wrong as far as Banerjee and Co's case is concerned? So if you look at what was wrong with the credit report of Banerjee, it could be a variety of these reasons. It could be delayed loan installments on the loans that this company had taken in the past. There could be delayed or unpaid credit card bills, which is again a default. There could be loans which have been written off or loans which are settled by the bank. When you talk of written off loans, those are loans where the bank has sort of written it off from the books because the borrower is not repaying it. Settled loans could be cases where, let's assume that, it was 100 lakhs of loan which was taken, and because of the problems that the company was facing, they were not in a position to repay the loan in full, and said that the bank said that, we'll settle the loan. In essence, the bank was making a loss of 30 lakhs on the loan. The fourth important thing is if multiple inquiries have been made on the by Banerjee and Co, and by the banks, by various banks, in terms of trying to understand how this credit profile is. And the last is in terms of the number of loans that Banerjee and Co had. So greater the number of loans, it means that Banerjee and Co or any company is going to be really credit hungry, and therefore will sort of signal that this particular entity could be an entity which could cause problems in the future. So all of these information are captured in the credit report, and it could be one or it could be a combination of these factors which could have resulted in the loan being rejected by the bank. So the credit report, we will see a sample of it in the later part of my presentation. This is just to show you, what are the various causes for the loan to get rejected. So some of you might be wondering how banks get the credit report and who actually creates the credit report. Now, when you first apply for a loan, let's assume that you've never applied for a loan. The first time you're applying for it, obviously there is no credit history as far as you as a borrower or you as a company are concerned. So you would apply for a loan. The banks will go through a traditional process of going through the entire appraisal process and then sanction the loan. Now, once a bank either grants you a loan or grants you a credit card, is when the repayment from you would commence, both in terms of the interest and the principal that you have to repay to the bank. And the bank keeps a track of how the repayments are flowing back into the bank. The bank then would share these details with the credit bureau. It could either be the loan details and the loan repayments, or it could be the credit card and the credit card repayments. So this repayment experience is captured by the credit bureau. Now let's say hypothetically that you apply for a second loan to another bank, or it could be the same bank itself. You would find that when you do this process of filing your application with the bank with whom you're trying to seek a loan will get the details about your credit history and all your other loans and all your other credit card payments from the credit bureau. The credit bureau will provide a credit report to the bank so that the bank gets an idea of what sort of a borrower are you. So the bank will get a credit report from the credit bureau. I'm sure that many of you who, as individuals who have either sought housing loan from a bank, you would have gone through this whole process of the bank seeking a credit report and either granting you a loan or rejecting a loan on your behalf. So the credit information sharing is essentially where all the credit related information is shared between the banks and other lenders and the credit bureaus. When we talk later about the regulations and the act, you'll find that all banks in India have to obtain a customer's credit report as part of the loan appraisal process, and the credit bureaus update the credit information about you and about the company on a periodic basis, and that is something which is captured in the credit report. So if you go back to the case study quickly, you find that Banerjee & Co, the company whose loan was rejected, has the negative information, and it is possible that the bank officers saw that the report had an unpaid loan. So essentially the bottom line here is that make sure that you always borrow within your capacity to repay, so that you avoid whatever delays or non-payments are concerned. And the bad credit behavior, which I outlined earlier, which could involve things like delayed payments or defaults or settled loans or written off loans, should be avoided. If you look at Mishra & Co, the contrasting company where all the loans were being paid in a timely manner, and there was a good credit history and therefore a good credit behavior with no negative remarks, which sort of allowed the bank to offer the loan to the company. So what is a credit bureau? So the credit bureau essentially is a company or an entity which essentially collects and stores the credit related information. All it does is to process the information and prepare the reports. They also come out with certain value added products like the credit scores, which forms part of your credit report. Now, when a bank accesses this report from the credit bureau, there are two things that they go through in detail. One, of course, is the report to get into the nitty-gritties of how your payment track records have been, and also look at the credit score based on the calculations that any of the credit bureaus would have done. So, based on these two factors, the bank uses the scores and the report to decide on the loan sanction or not. Now, is your information safe with the bureau? Obviously, it is safe with the bureau. The credit bureaus are regulated by the RBI, and they come under the Credit Reporting Companies Regulations Act of 2005. The regulations ensure that data is safe and private. only the bank to whom you have applied for a loan will have access to that report of yours. Or if you want to know your score and what your track record has been, you can also on a payment of a small sum of money can access your report. One important thing that all of us need to remember is that the credit information or the credit bureau is not going to be changing any of the information that it gets from the banks or any of the companies. It only processes it to churn out these reports and scores. So there is no tinkering with any of the data which comes from the banks or the credit card companies. So who are the users of the credit bureaus? As I've been talking all along, the banks and lenders are the users, the prime users of the information from the credit bureaus. All lending institutions have to be members of all credit bureaus and share information with all bureaus. So there are 4 credit bureaus, which I'll talk about it in the next couple of slides. Once they get this information, once they submit the information, and if there is a prospective borrower who approaches the bank can source a report from either of these 4 bureaus. It is not necessary that they have to source 4 different reports of the same customer from 4 different bureaus. As far as individuals and entities are concerned, you can access their own credit reports on a payment of a small sum of money with these bureaus. There are other entities which have access to the credit bureaus, which include insurance companies, telecom companies, there could be credit rating agencies, brokers, the regulator SEBI, the insurance regulator IRDAI. So these are also other entities who have access to the credit bureaus and the information contained there. So there are 4 credit bureaus in India today, and as I told you, they're regulated by the Reserve Bank of India based on the Credit Bureau's Credit Information Companies Regulations Act of 2005. CIBIL was the first one which started in the early 2000s, and followed by Expedient, Equifax, and CRIF Highmark. So these are the 4 credit bureaus in the country today, of which CIBIL, Expedient, and CRIF Highmark provide both consumer reports as also the reports and companies. Equifax at this point in time provides the consumer reports. It is also important for us to not confuse credit bureaus with credit rating agencies. Sometimes people assume that both are one and the same. I think there's a big difference between what a credit bureau is and what a rating agency is. And the first important fact that all of us need to understand is the credit bureau is not a credit rating agency. The credit rating agency, as some of you would know, are those entities which provide an opinion in terms of the probability of default of the underlying borrower through a set of symbols which could range from highest rating of AAA going downwards to AA and A and so on and so forth. And ratings are based on a number of variables, both on the business side, the financial side, and the industry management. And the other important difference is that the entities which are seeking to borrow from the marketplace are the ones who initiate the entire rating process. So currently there are 6 rating agencies in the country: CRISIL, CARE, Brickworks, and SMETA. So if we look at the credit bureau, as I mentioned, it provides a report based on the past repayment track record. So it's a snapshot of the credit behavior of the underlying borrower, which could be either an individual or a company. And the output will be in the form of a report and the scores. Scores typically range between 300 to 900, and they store only the entities' activities on any of these credit borrowings that they have done from either from the banks or through credit card companies. So having understood that, let's look at what are the details contained in the credit report. Essentially, we're going to look at what is the credit report, what are the various types of credit reports that one is seeing in the marketplace today, and what are the details that are available in each of these reports. So this is essentially what we're going to be talking about. As we've said, essentially it's going to talk about the repayment track record of all the loans and credit cards that you have taken in the past and the ones that you're currently repaying. So there are two types of credit reports which are now available in the marketplace. One is the individual or the consumer credit report, and the other is the commercial or the company credit report. Now, when you apply for your own personal needs, such as a car loan, or it could be a personal or a consumer loan, a housing loan, or a credit card, then the banks will access your individual or the consumer credit report. Now, when your company applies for a loan for business purposes, as we talked about, it could be a working capital loan or a term loan or any other business loan, the commercial or the company credit report is going to be accessed. Now, why are we talking about both of these reports and why is it relevant? Now, when you apply for a personal loan, like a car loan, the bank is going to only obtain the consumer credit report. Whereas when you apply for a business loan as a promoter of an SME, let's say, the bank will obtain not only the company's credit report or the commercial credit report, it's also going to get the consumer credit report of the promoters, the directors, and a host of other people who are engaged with the company. Because the promoter has a huge influence in terms of the underlying working of the company, also the philosophies and the sort of repayment rates the promoter has will have a bearing in terms of how the company's repayment track record also can be. So you will need to know that both of these reports are important, especially from an MSME borrowing perspective. Now, if you go back to the case study and say, for instance, that this Banerjee & Co had repaid all its loans in a timely manner, but the promoter, which is Mr. Banerjee, had defaulted on some of these loans and had also settled some of these loans on both the personal loan and the credit card. Now, will the bank reject the loan or accept the loan? Banerjee's & Co, the company's loan will still be rejected because the bank is going to check both at the company level and at the promoter level in terms of what their repayment track record is. Also, they will seek individual credit reports of all the other related parties of the company, which typically will be under the relationship details section of the credit report, which I'm just going to show you now. So you will find that the non-payment by the promoter, in this case Mr. Banerjee, will cause a rejection of the loan for the company. So the bottom line is not only the company but also the individual's repayment track record has to be good. The reason why I'm stressing on this point is that many times the SMEs, from my experience of having done this in other centers and other fora, we found that many times they're not aware that both of these are actually looked at very seriously by the banking system. It might assume that it's enough the company's loans are repaid in a timely manner, and the personal part of it may not really affect the lending decision. So let's look at in detail the individual credit reports and commercial credit reports. What I'm going to be presenting to you is only a hypothetical report. Obviously, if you want to really look at some detailed samples, these are available in any of these websites of these 4 credit bureaus. So if you look at, let's start with the individual credit report. So if you start with the individual credit report, first section is in terms of the personal details, which essentially outlines the demographic details of the individual. You will have the name, the date of birth, gender, and of course, you will have the various identification requirements, which could either be a PAN card or a passport, driving license, and so on. Now, obviously, in this example, if you look at Arun Kumar as a name, obviously in a country like ours, you could have so many such names as Arun Kumar across the country, who could also have a very similar date of birth. So the key thing here is to, as far as the bureau and as far as the reporting is concerned, is to figure out which of these identifiers sort of distinguishes one Arun Kumar from another Arun Kumar. So obviously it can be any of these identification requirements. It could either be a passport number or a PAN card number and so on. So this is essentially what is captured here. As I mentioned earlier, these are only sample reports. The reports in different bureaus might have a little more of additional details also. But broadly, what I'm presenting sort of represents what most credit bureaus will carry as far as their reporting is concerned. And then comes the credit facility and the accounts detail section. It essentially outlines all the open, which means all the current facilities that you have with the lenders and also those sort of facilities that you have closed. This section basically is to assess the following. One, what are your total credit facilities? What has been the month-on-month payment history on either the loans or the credit cards? What are the different types of loans that have been borrowed? And what has been the quantum of those borrowings? So typically it looks like something like this, wherein you'll have the member name, the account number, the ownership again here, what sort of, are you going to be individual or are you guaranteed for somebody else and so on? The dates on which the loans are opened, closed, the last repayment and so on. And then comes the account status as far as the credit limit is concerned. What has been the highest level of credit, the cash limit, what is the amount which is overdue, the various terms of the loans, and you also have details of the various types of collaterals, and then comes the status. So it's going to be assumed, let's assume that the borrower is not paying. Because of any of these classifications, this is also going to be captured. Is it going to be suit filed, or is it going to be willful default by the management, or is it going to be a case of where the bank has written off, or is it a case where the bank has settled in negotiation with the underlying borrower? And then you have the payment history. Typically, you can have a payment history for about 36 months for each of these loans. So you will find, depending on how each of these banks report, you will have various symbologies here. For instance, if it's 000 here, it means that there will be no delays or overdues as far as that particular month is concerned. If it's going to be standard, it would essentially mean that the loans fell in the 0 to 90 days, past due bucket, which essentially means the loan is still a standard loan as far as the bank is concerned. And sometimes banks report by saying that, it is 30 days overdue, for instance, as in this case here. Then comes the inquiries that have been, the inquiry section, which essentially shows, are you credit hungry in terms of seeking credit on a regular basis? So the more inquiries that have been made by the banks to whom you have sought funding, it means that you are, as an individual, looking for more and more of these loans. So it helps the bankers to know how often you have applied for a loan. Let's assume that you went for a housing loan and you did not get it from a particular bank, and then you hopped on to another 4-5 banks. All of that information is captured here, which means the 6th bank that you go to must be wondering why the other banks have sort of rejected your loan proposal. So the greater the number of inquiries that are figuring here, it means that the banker is going to have more and more doubts in terms of your underlying credit capacity. Then comes the credit score. So based on the contents of your credit report, the credit bureau, based on their own criteria of looking at all of these factors, will assign a credit score. Now the score typically would mean that higher the score, better is your probability of getting a loan from the bank system, because the chances of you defaulting is going to be that much lower. So if you look at individual reports, you should obtain a copy of the consumer credit report. I think many of you might have read that the regulator has said that effective December, credit bureaus have to provide one free credit report to any individual who's asking for it. Obviously, it's only going to be a report; it will not be the score which is going to be provided. Otherwise, you have to pay 550 rupees. I think is what some of the bureaus charge to get your own individual report. Now, a good policy would be to get a copy of the report and to make sure that all the information is correct. If it is incorrect, there is a mechanism to sort of correct it. Make sure that all repayments are made in a prompt manner as far as loans and the credit cards are concerned. And always try and ensure that you do not borrow beyond your means. Because if there's going to be a delay, it's going to sort of cost you if you plan to take a loan in the future. Don't seek too many, don't apply to too many banks for the same category for loans. So that's again going to show that you're a credit hungry sort of, sort of borrower as far as the bank is concerned. All information that any of the borrowers provide in the application form should also be accurate and correct. And one important feature that you need to know is if you're going to be a guarantor and if you're going to be a co-applicant, the actions of the persons on whose behalf you are providing the guarantee and also being a co-applicant will have a bearing on your overall report and your overall score. So let's assume that the individual to whom you've guaranteed is actually going to be defaulting. It means that it's going to reflect on your credit score as well, because the bank has not been able to get the money from the borrower. So if you look at the commercial credit report, there are slight variations as far as the overall reporting is concerned. Again, like in the individual report, you will find that there is a company or the entity profile, and essentially this particular section outlines the identity and the demographic details in terms of, for instance, there could be a legal classification, legal constitution of the company, whether it's a private limited, whether it's the proprietorship and so on. And you find that the rest of the details in terms of the sort of classification of activity, etc., as per the RBI handbooks. So this is typically what is contained in the profile of the company. Then again gives you the next section is the summary section, which is the report summary, which gives a snapshot of the overall contents of the report. So here we would say that there is one credit grantor. There are three types of credit facilities. One of them have been closed, which also tells you when was the latest facility opened, when was it closed, what are the credit facilities as the borrower and as a guarantor. Outlines, whether the account is a standard account in the bank's books, what is the content. If it's not standard, what is the content as far as the substandard account is concerned, and then the reasons why it is not standard. It could be lawsuits or it could be willful default. So this is the extent of data which is captured here. Remember that this is only the summary, so obviously the details are following here. So you will have the breakup in terms of what type of credit it is, whether it's overdraft, whether it's a demand loan, whether it's a long-term loan, and so on. And then it's broken down into various of these asset classifications. So this is the sort of detail that you would get to see in the commercial credit report. Then comes the inquiries summary. Just as in the case of individuals that we saw that greater the number of inquiries that you've made, greater is going to be your credit hunger, and therefore seen as or perceived as a negative as far as the bank is concerned. So, for instance, in this particular case, you'll find that in about 12 months, in about 24 months, about 17 inquiries were made. So totally over 24 months, you find that there were 3 and totally about 20. It also outlines when the last or the recent inquiry was made. Then comes the relationship details. This again provides details on the key persons. It will be details not only on the proprietor or the partners, It will have details on all the directors who are part of the company, and this information is very important to assess the creditworthiness of the entity, because the credit bureau will capture the individual credit reports of all the related parties. So let's assume that there were two partners, and there were both the partners were directors, and they had brought in a couple of more directors. So you would have details on all the four individuals as far as their individual credit reports are concerned. So if you look at the contents, the credit facility and account details section will give the detailed information on every credit facility which is availed by the entity, and that is what we saw. And for each of those, you would get an account status, and you will also get a detailed month-on-month payment history, as we saw. That's essentially called as days past due. So this essentially will tell you that the sort of credit which is availed, what is the current outstanding, what is the total debt, and so on, and of course the payment track record or the payment behavior. So for instance, if you look at the account details section, if you look at one of the credit facilities here, you will have the type of credit facility, the amount which is sanctioned, what is the balance here, how is it classified. It's a standard asset, which means the repayments are coming on time. They're not a willful defaulter, nor has this loan been a suit filed sort of an account. When was the last reporting? And then you will have, you can either have, normally you can go up to 36 months. So here we've just shown 24 months. This again is the inquiry section. So just as we saw in the individual report, you will find, don't get carried away by these numbers, because typically sometimes if the bank is not knowing what sort of funds they're going to give the borrower when they make an inquiry, they just fill in an arbitrary number there. So again here, TUMI inquiries in a short span shows, so here you can find that the short span of just about maybe 6-7 months, that they've already made 6-7 inquiries. So again here, just as we talked about in the individual credit report, again, do not borrow beyond means, which essentially means that make sure that your underlying cash flows are able to support the sort of borrowings that you have. So the rule for SMEs is not to over leverage beyond what they can, and again make sure that both the individual as also the sort of company details that are being provided as far as the loan documentation is concerned is accurate. Late payments are shown in your report, so ensure that all payments are made in a timely manner, both interest and principal. And a very, very important point is to ensure that all promoters, all directors, all partners maintain a positive credit behavior. And this is typically an area where not much importance is paid. So if any of the partners or directors are found to be not very creditworthy, that can sort of impact the lending decision. Of course, limit inquiries, and I think this I've repeated, saying that maintaining a good credit history. So with the reports, let's move on to the credit score. What is a credit score? What is a good credit score which the banks consider to be good, and what is the sort of impact the payment behavior can have on the credit score? So if you look at the credit score, essentially it is a quantification of the overall credit worthiness of the individual or the company based on all the data and the information that is provided by either the individual or the company. So typically, if you look at it, it will be a combination of what has been the repayment history and a variety of loans. What are the total loans that have been availed? What are the outstanding loans which are there on the books of the company or that the individual has to pay? the sort of inquiries which have been made by the individual or the company, and also what, from an individual's perspective and both from a company's perspective, what is the mix between a secure and an unsecured loan. Now, for instance, if you look at individuals, if there's going to be an over-reliance on unsecured part, for instance, credit card, for instance, there's going to be a huge level of outstanding in the credit card. It sort of gives an indication that essentially the underlying borrower is not going to be creditworthy, and you can expect delays from that. So based on all of these factors which are collated by the Credit Bureau, they have their own internal criteria, they have their own internal algorithms and models to score. Now, is this publicly available, the algorithm? No, those are the criteria, the sort of weightages for criteria, etc., something which is proprietary to each of these credit bureaus, and therefore what you would get would be the report and the final score. So the credit scores may vary across bureaus. As I mentioned earlier on, the normal score range is between 300 to 900, with 300 being the lower end of the spectrum and 900 at the higher end of the spectrum. So as you move closer to the 900 range, the probability of you getting a loan also stands to increase. And an important point again, which I'm repeating, is that this score is not a rating. So it is only one of those factors which will be taken into consideration by the lender in making the credit decision. All these numbers that are coming out of the credit bureaus have nothing to do with the conventional credit ratings. So this will also be one of those inputs which goes into the overall credit making decision process. So what is considered to be a good score? Now, over a period of time, it has been found that as banks have started using this and are now using it regularly, because no proposal can move without having a credit score, it has been found that a score of 750 and above is being considered to be a fairly good score. And it should also be noted that a good score does not guarantee the acceptance of the loan application. It is one of those inputs amongst the various other inputs that I talked about earlier on, which will include industry, the management, and so on and so forth. So it will also depend on other factors in the report and also the appraisal criteria. So there could be instances where someone might have got a 750 and still have been rejected for other reasons. So let's look at the impact on credit score and why it's important for everybody to ensure timely payment of loans and credit cards over a period of time. Now let's look at the repayments, or let's look at the sort of repayments on the personal loan of Mr. Banerjee, the example that we looked at earlier. So you'll find that from January 14th to May 14th, the repayments have been good, and after that is when the problems have begun, where the repayments of the past dues have slowly moved from 30 days to 150 days, which essentially means that there was a temporary phase during which there was a problem. Maybe the cash flows are not sufficient, and therefore he was not able to repay the personal loan. But after that, it sort of became all right, and the payments started coming on time. And from November 14th onwards, the payments were back on time. So how does this impact the score? So if you look at the score and how it is impacted, you'll find that until May 14, you find that the score is actually at an acceptable range of 750. And then as the delays have started manifesting, the scores have also started dipping from 680 to 650 and so on and so forth. Now the interesting thing is, which is what many would wonder, that once I start making the payments, after these 5 months here, my score should ideally go back to 750. No, but the score is actually only 570. Now what is the reason for that? The reason for that is there has to be a certain cool-off period for the bureau or anybody else to observe whether the non-payment during those 5 months is only a temporary phase or it is something that will occur over a period of time. So there will be a period that is not defined. It can be whatever time, it can be 6 months, it can be 1 year, it can be, whatever be the time frame before it bounces back to what it was at the earlier day. So the clear indicator here is that even if you make a few delays there, your credit score can drop, and when you actually want the loan, although you're currently paying on time on your loans, you may not bounce back to an acceptable level of credit score for the bank to lend to you. So that's a very important takeaway here, that do not even delay a loan even for a month, because that can cost you heavily as far as the score is concerned. So if you want to capture the key takeaways here, it obviously means that higher the score, better the probability of you getting a loan, and banks are definitely using these scores in their lending decisions. Again, here, different banks can interpret the same score differently. So that is something that we need to talk about. And I'll also touch upon, why a particular score which might get rejected in a bank and be accepted by some other entity. We'll talk about that in a while from now. And of course, incorrect information can impact the score. It's also possible that many times, not many times, it is also possible that at times you'll find that sometimes the information there in the credit report is incorrect, or it's not updated. So if you feel that you've actually repaid and the information just kept in the report is showing a totally different picture, there's something called as a dispute resolution mechanism, or a process in place, which essentially tries to set right what anomalies that one finds in the credit report. So what is this dispute resolution process, and how does it work? Now, the rejection of any loan is possible because of, one, the information there being wrong, and it's also possible that the information did not belong to that particular individual. It is also, a third situation can happen if the loan was actually repaid and closed, but the bank did not update this with the credit bureau. So it's any of these circumstances, you could find that the scores are quite different from what it can be. So the key thing is that all borrowers have the right to raise this dispute with the credit bureau if there is any wrong information which they think is wrong. And this is essentially called as a dispute resolution process. So these are based on the underlying guidelines for the credit information bureaus, and all stakeholders in this, not only banks but also the credit bureaus, will have to adhere to this whole process of dispute resolution. Now, dispute resolution process essentially starts by the consumer sending the disputed information to the credit bureau. The credit bureau will contact the bank to correct the data, because obviously the credit bureaus will not on their own be able to correct the data, because all they're doing is to aggregate the data which they get from the banks and put it together. So the bank will either correct or confirm that the data which is provided there is going to be correct. So this is essentially what the whole dispute resolution mechanism is. There is a time frame of 30 days to resolve the dispute, because the credit bureaus have to get confirmation from the bank as to whether the data is right, whether the data is wrong, or there is a mistake from the bank's updating process or not. So when the dispute resolution is underway, you typically find that those sections of the report which are under dispute will be highlighted by a red color. If you actually see the report for yourself, you will find that whichever areas are going to be disputed, those are actually highlighted by the credit bureau. So you could either approach your own credit counselor, or there are these ombudsmen who will be able to help you with resolving these issues, provided you are on the right side and you have every right to set any wrong information about your credit history. So the key points to remember are, one, of course, the bad credit practices, their consequences, and likewise the good practices, and the key takeaways for you from the session. So if you look at some of the bad practices, borrowing too much in relation to what you're able to pay, again, is going to increase your indebtedness and increase your liabilities, and therefore your inability to make the payment. And if you're not going to pay installments in full, obviously there's going to be a higher rate of, you're going to be charged interest on the pending balances, which again is going to impact your finances. Not paying in time is going to impact your credit report and therefore the future borrowing as well, because it's going to be seen as perceived as a negative behavior. And making many loan applications with multiple banks can again be a sign of poor creditworthiness as far as the banks are concerned about you. So if we look at good practices, again, decide whether from a, let's say from a company's perspective, decide on whether you want a working capital loan or a term loan, and based on the underlying purpose. And if it's going to be a company, make sure that your underlying cash flows are able to support these loans. Many times you would find that SMEs being at the lower end of the, the lower tier of compared to the other larger, manufacturing companies or the OEMs, will find that if there's going to be a cyclical downturn, they will also get impacted quite adversely, and that can sort of impact the cash flows. Important for everyone to check, everyone who is listening in and everybody to check, what your credit scores are before you make a loan application. Let's say that, we're planning to buy a house maybe a couple of years down the line, and it is important to check what your credit score is, because if you don't have a good credit score, you're not going to get a loan from the banks. So anybody, could be both the companies and the individuals, need to check their credit score and take corrective actions, and maybe sort out if there are issues with the loan repayment, or if there are issues with the credit card payment, or if there are factually incorrect issues in the report. It's a good time to correct it and set the house in order. And also make sure that all installments are paid in a timely manner. And of course, the benefits, I think, is there for all of us to see that your borrowing becomes easier. You would get finer rates of interest, and you might get, a lower collateral requirement for your borrowings. And of course, you will get, I think more importantly, you will have access to finance in a very timely manner. Now, one of the other things that I talked about also is that if you say that, instead of 750, that you got a score of 650, for instance, while, the bank may not have sort of given you the loan, it is possible that there could be other entities in the financial sector space. For instance, entities which are willing to take a little more risk. It could possibly be, some of the non-banking finance companies, where they are willing to sort of, take that risk, with a slightly lower score and still give you the funding that you require. So those are things that are possible. So it is not that, if the score is, let's say 650, all options for financing are closed. So maybe the bank doesn't give you, but any other entity which can sort of provide you that loan, understanding the sort of risks that are inherently present in the borrower, might be willing to give you that loan. So if we look at it, some of the key takeaways, and I think definitely important for everyone to remember. The first thing also is that every time that you apply for a loan, you will have a credit report on you or the company which the bank is going to use. Secondly, both the promoter and the company are linked, and therefore both those reports are going to be analyzed by the banks. Again, I think the guarantor co-applicant issue is very, very important, and which essentially means that when you're going to become a guarantor or a co-applicant to anyone, make sure that the underlying applicant is going to be of a creditworthy nature, otherwise it's going to impact your credit score. And of course, I think as we've been talking about, the credit card is again a form of credit, and the repayment track record there is going to sort of impact your report as well. So I think I've finished as scheduled at 3:45, and I think we can open up for the question and answer session. So I'll try and answer as many questions as I can with the time that we have. We can just open up the question box. I can sort of see it.